Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host. I'm so glad to have you on board today. We've got a great guest, Michael Parks, all the way from beautiful Massachusetts, one of my favorite places. We just were talking about it, and if you haven't been to Massachusetts, make sure you go. I mean, it's just a beautiful place. You got mountains in the Berkshires, you've got the beaches, Cape Cod. Boston's a classic American city, one of the first. Lots of history. It's got everything. Not to mention some pretty awesome people. It's a really good food. So, in any case, Michael, thank you so much for joining us, man. I know we're lucky to have you, and I really appreciate you taking the time to do this.
Thank you, Gary. Really appreciate being here and saying all those nice things about my city and my state here. And we love to have visitors, and hopefully everybody gets a chance to come up and see us. And feel free to drop me a line if you do or when you do.
Absolutely. You can look forward to it. So if you don't mind, for everybody listening, Michael and I were just talking about our backgrounds, very similar backgrounds. I mean, technology, military. So Michael, if you wouldn't mind, share a little bit about what brought you to where you are today, and then we'll move forward with what you're currently doing, and we'll give people some we call golden nuggets.
Yeah, that sounds great. So, out of college, I was a technology guy. I joined a company called Accenture, which is a very large business consulting, technology consulting firm working with military and also Fortune 500 companies. And I did that for many years, really liked it, learned a lot of project management, which is a key skill that I continue to use today, in addition to the technology. And, I just always wanted to do my own thing, right? I want to own my own business. I want to run my own business. And I tried a few different things before I settled into real estate. One of them that I tried is I actually opened a bunch of hair salons, Great Clips hair salons, and maybe we could talk about that at some point. But that turned out not to be exactly what I was looking for, and then found real estate. And I found real estate by taking a senior technology position at some publicly traded REITs, so real estate investment trusts, 30 billion in assets under management. And although I always had a passion for real estate, and I did do some things on my own for real estate, that's where I really sort of learned the big business of real estate and how to make that work. And so that's when I set off to say, all right, how do I build a real estate business that's not just my personal investments, but also building a business where I can bring others in, make them money, show them the world of real estate, and move forward that way. So that's where I really got into real estate, launched into syndications, and now I'm running a fund called the Navigator Wealth Fund at navwf.com. We have a great partner team in the fund, and we're doing some really exciting projects.
Well, I appreciate that's a great introduction, by the way. And so I was looking at some of the topics and questions before we started speaking, and you just led me right to where I think we want to start. Um, some of us still work. Like when I started investing in real estate, I was still working. Even when I got my real estate license, I'm not like a typical realtor. I don't really do that stuff. I help people with investing. I was still working, and I did that for a while. And so when you do that, what happens is you have passive income from your investments, you have earned income from your job, and if you're a contractor, 1099 income, W-2 and 1099. But most of us have retirement accounts, 401ks, Roth IRAs, and things like that. So retirement is kind of a big thing, and I see you have something that you call the retirement 4% rule. And can you describe what that is, and how do we beat that? 4% by today's standards is not even as much as inflation. 10 years ago it would have been great, but I'm sure there's a story here. So would you mind expanding on that a little bit?
Yeah. So that's really kind of beyond real estate. Just there's been studies done over long periods of time, mainly investing in the stock market and looking at stock market returns. And the rule goes like this. You need to be able to live on 4% of your invested assets in Wall Street to retire. And that 4% accounts for 4% that you actually get and you can use to go travel or do whatever you're going to do in retirement and live. But Wall Street typically returns a bit higher than that, so you have to account for taxes, then you have to account for inflation. So the 4% rule is, I think if you talk to a lot of Wall Street brokers, they would cite the 4% rule as, that's what it takes to retire. So that's also like 25. Another way to think about the 4% rule is that if I need 25 times as much money invested as I need to live on. So if I need 100,000 to live on, I need $2.5 million invested, right? So that's kind of a rule of thumb used by people who invest in Wall Street, stock bond portfolios, and so forth. And I just think that I know there's a lot better ways to make a better return than that. And it takes some effort, right? It takes some effort. So investing in mutual funds on Wall Street is pretty simple. Not a lot of thought goes into it. Maybe your broker helps you with some allocations. But if you're gonna do better than that, you need to put a lot more effort into it, whether that's you're a stock picker or what I love to do, and I think what a lot of us love to do that listen, is real estate. And you can really make a much better return investing through real estate or investing through real estate related vehicles. And there's a few of those. And so to me, that's how you beat it, right? If you could even get, let's say, 8% of a return, back in your pocket, because there's tax advantages to real estate and all those things, you just cut your golden number, the number you need to retire, in half. So all of a sudden, 2.5 million, 1.25 million, you just got there a lot faster by being a smart investor. So
yeah, I agree 100%. I'm in the stock market, but real estate really, that's what bought me my freedom. That was the real estate is actually the foundation upon which I launched other businesses, invested in other different types of assets, non-real estate assets, but really it was real estate that made it all happen. It's one of the reasons is the return, the actual cash on cash return was so great because I could buy a property and put down 20 or 25% and get a really good bank note on that with good interest rate. I did private money and hard money all over the years, but really when I went in with a strong cash position, I always got the best price and got the best financing. So the reality is my returns are really based on what I put into it cash wise, not what I borrowed. So when you do it that way, it's like the returns are just phenomenal, So let's kind of unwrap that a little bit. Here we are, we're 2024, and there's some uncertainty in the market. We've got some global things going on that are concerning and political things. And of course, I tend to block all the rhetoric out and focus on just the facts. But the facts are what the facts are. I mean, we've got some maybe some commercial challenges coming up in the financial world. But what's your take on, how are you position yourself in today's market? When you look at the different real estate classes, what kind of things are you seeing and sort of planning for, I guess, is the question,
Yeah. So when I was at the publicly traded REITs, we did a lot of commercial office space. That was one of our key asset classes. And I think, as you just alluded to, everybody has been expecting and is still expecting a fairly significant buying opportunity in commercial office. And so commercial office, essentially what's happening is after the pandemic, the vacancy rates continue to be high. Commercial loans are typically shorter term, 5 years is typical. Those have been coming due. And as they come due, the value of the building is significantly lower because of the high vacancy rates. Because as companies are deciding they just don't need as much occupant or not as much space, and so they're letting their leases elapse. There's not a lot of demand. So what's happened in the last year and a half, 2 years, is that a lot of the banks that held these notes did some extensions, and they extended them out a year or 2 years. And now we're at a point where the dollars of commercial loans, office loans coming due this year is more than double what it typically is, almost approaching 3 times as much. And they're just not going to keep extending it forever. So we get into this situation where the landlord is going to have to do capital calls, bring in capital to maintain the building because it's not worth as much anymore and it's highly leveraged. Smart operators went and re-leveraged all their commercial property when interest rates were low, and basically you get that comes due at some point. So a lot of opportunity coming in commercial office to get, and I would look at high quality, like A-class assets, because I do think that the whole office space market is not coming back to where it used to be anytime soon. So you want to be in the buildings that will definitely have demand, which are the best buildings. Now that's not an area I'm particularly targeting right now, but I think it's an opportunity, and you brought it up, so I wanted to address it. What I like right now, I still like the multifamily space and self-storage. And I have a partner on the Navigator Wealth Fund who's one of the biggest self-storage operators in the greater Wisconsin or greater Green Bay area of Wisconsin.
Okay.
So we like self-storage, we like multifamily. Both of them have been overheated, I would say, to some degree. Prices are just higher than what is likely to pay back unless the market continued to progress, and we're starting to see it stall a little bit. So that's created, that and some other things have created a real sweet spot in private money lending into multifamily. And I'd love to talk more about that when you want. But I think that's where I think investors should be, and that's where I'm putting my money.
Yeah, I agree 100%. Everybody listening, this is really important. So I really don't want to wait anymore. I want to go ahead and hear all about it.
All right.
We've got, so just to position it, so you got conventional financing with traditional banks, brick and mortar, commercial banks, and so forth. You've got private money, and a lot of people think private money is hard money, but it's not necessarily so. All hard money is private money, but not all private money is hard money. Hard money loans are a small sector of a bigger pool of private funds. So having said that, if you can go and dive in, help explain to people a little bit of one-on-one level, and then maybe some examples of what you've seen and maybe things you've done before yourself with either lending private money or also using private money yourself to invest.
Yeah, sure. So basically, a private money loan is when you as an individual, or maybe a group of individuals, which is the way that we're doing it at the Navigator Wealth Fund, you're essentially the bank or the lender, right? Now, you're not a bank, but you are a lender to a real estate developer or a real estate operator that needs to get funding. They need to get a loan. And so look, I usually get some questions like, well, why wouldn't the borrower just go to a bank, right? I mean, why wouldn't you just go to a bank? Because I think a lot of people think like that's what you do when you buy a house. So just that's the way it works. And I would say that a lot of operators, if they can go to a bank and they can qualify for the bank's requirements, their project qualifies, it fits their box and so forth, you're probably going to get your best rates there. And that's a great option. What happens is that developers their projects are not fitting into many lenders' boxes. And so things like self-storage for a long time they were like, that's not a multifamily property, it's not an office. Now that's become more mainstream, but self-storage has challenges in getting good funding. And then even whether it's a heavy value add on a multifamily property. So if you don't have occupancy, like let's say you buy a building that's half vacant or even fully vacant, and you want to do some major rehab to it, that's a whole different type of loan that many banks will either say, no, we don't do that, or maybe they do it, and it's a lot harder, a lot of personal guarantees, different things. So I would just say as the project gets a little more complex, it gets a little more complex in terms of how to get funding for your project as a borrower. So that opens the door to private money lending. So, a lot of times you'll need to go to a debt fund or a fund that's operating. Maybe they're providing bridge debt or hard money loans. And, bridge debt is usually bigger, a little bit longer term than your hard money. And so those types of options come from debt funds or private money lenders. And sometimes they often will sit in first position, but sometimes they'll be in second position. And so from an investor standpoint, you can get a much higher return, right? I mean, when you're the game in town with the money to support the project, you can charge a higher interest rate because they don't have a lower cost bank option available. And so for a lot of people that are investing, and what we think is that that's a really great risk adjusted return place to be, because your return is relatively high, maybe slightly lower than what you could get as an equity investor, but you're much more protected. All the equity in the project doesn't get paid out until the loan is paid out. Loan's paid out first. So it's a great risk position to be in at an elevated return level.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to GaryRealEstateWithGaryWilson.com. Click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Yeah. I like it. The whole concept of flipping homes, for example, and you actually, you don't have to just flip single family homes. I mean, that's I actually bought a lot of rentals first before I ever flipped a home. When I started flipping, I assumed, well, that's the only thing you flip. And then I realized when I started with workers, we can flip anything. You can flip the first multifamily I flipped was a 15-unit building, and it was a much bigger return. So it's just it's the same game. It's just bigger projects and bigger properties and bigger numbers. And REITs kind of do that too. I notice a lot of REITs they'll buy really good high quality properties, and then I'm not saying they don't care about the price. They certainly do. But their game is to actually raise the value by raising the rents. And then they'll do that over a period of time, 3 or 5 years or something, and then resell it. And they'll cash out. They'll also use what we call cost segregation. They'll take all the other than the building, all the equipment, paint sprayers and lawnmowers and snow throwers and refrigerators and stoves, and depreciate those on an accelerated scale because the IRS code allows you to do that. And that would really be their game. They would literally buy a property just to do the cost segregation, get that done, and then go out and resell the thing. Just an amazing way to get a great return on your money. So you can use short-term loans to do those things, the private money. And they're happy because they're getting 10%, but they're getting it in 6 months, that kind of thing.
Right.
So yeah, I just love that whole concept. So let's go ahead. I want to move into uh, so for people listening, I guess I should say this. We have a lot of professionals, a lot of business owners, from what we can tell from podcast reviews and people just reaching out to us, calling us, emailing us, hey, I saw the podcast. I want to learn more about that. Some of them want to borrow the money to do their own projects, and some of them want to be a lender. We have several people in the medical field, but one surgeon in particular, excellent investor. He just doesn't have the time anymore to go be looking at these car washes and laundromats, and he likes those kind of businesses. So he started lending, and he's much happier, much less work. It's a secured way to do things. But how can this fit in? Actually, let's talk go back to the retirement. So we can build assets, we can build a portfolio of assets, i.e. real estate, but we can also leverage further what we have in cash in, Roth IRAs and 401ks and self-directed IRAs and things like that. Do you get involved with those kind of things too, or kind of, if you don't mind, discuss that a little bit, because I want people to hear there's more than one way to participate in this game, you know?
That's right. Yeah, that's a good point. So in order to get into the types of things that we're talking about, they're called private placement memorandums or private placements, which means that they're basically an offering, but it's not publicly traded on Wall Street. And to do that, most of your Wall Street firms that have you service your 401ks or your IRAs, they do not want to participate in that because you're basically pulling money out of their hands and putting it into what you want to invest in. So they make it hard to do, or they just won't do it. It's also more paperwork for them, and they make no money on it. So, the Fidelities of the world, typically, you'll get a no on private placements. But there is, as you mentioned, self-directed IRAs and 401ks. So basically, providers that are set up to do private placements. And so you can basically roll over your funds out of your 401ks, Roth or traditional, out of your IRAs, Roth or traditional, into these other providers. They would be your custodian, as you would have maybe a Fidelity or a Payne Webber or UBS or whoever. And you pay them usually a flat fee. It's not too much money. And then you're able to then invest in anything you want, right? Pretty much. There are rules about what's allowed, what's not allowed, but generally speaking, if it's a private placement and you just want to make an investment, you're not involved with the deal, those types of things all work. There's some restricted transactions. I don't think it's worth getting into here today, but it has to do with you being involved with what you're doing with your money, beyond just investing in it. So step one, if you want to do this, is get into one of those self-directed retirement accounts. And we've got some information on how to do that. You probably do as well. So reach out. We can refer you. There's a lot of companies that do it. We've got some perspectives about which ones we think service customers or their investors the best. But it's really your choice. So once you've got your money in that retirement account where you can invest in PPMs, now the world is open to you in terms of what you want to invest in. It includes things outside of real estate, gold, crypto, oil wells, all kinds of things. So I'm a real estate guy, so for me, it's always real estate. And there's you can invest in equity or you can invest in debt. Right? You can be that private money lender to real estate as well using those funds. And there's some unique things about lending that are particularly good for people who are in IRA accounts. So you have 401ks and you have IRAs, and people usually think of them kind of like the same thing, and they're similar in a lot of ways. But one of the big differences between a 401k and an IRA is the IRA tags what's called UBIT, or unrelated business income tax. And that comes into play if you invest in a building and that building has a loan on it. And now you're making money off of really borrowed money. And the IRA rules say, well, you got to pay taxes on that. And now you get your IRA, which is supposed to be tax-free. You got to start paying taxes. And, it's not the end of the world because you are making money on money that is not yours, it's borrowed money. So it's reasonable.
Yeah.
But the great news is 401k, you don't have to do that. But if you're in an IRA and you lend, there's no UBIT because you're a lender. You're not an equity provider. Yeah. You're not making money on somebody else's money. You're actually just providing the money and getting your return. So for people with IRAs, the private money lending is a great route to just avoid the whole tax thing. And 401ks are great because you never have it anyway.
Yeah. Well, I do like both for different reasons. And self-directed IRAs, you're right. When you lend from inside that, there's other kind of elements of safety built into that. But also having, owning the real estate inside of an IRA too. Remember, if you buy a 10-unit building and keep it in there for 25 years, chances are you're going to have it paid off and it's going to have gone up in value. Well, the whole time it's grown, tax deferred. You're not, the thing is just growing. Well, you eliminated a major expense, by doing it inside that protected vehicle. Now, when you start taking money out, of course, you've got to start paying whatever your rate is at that time. And people can make the argument, well, I'm probably going to be a lot wealthier, so I'll pay a higher rate. Well, maybe not. But also remember you might have other options in too. I would rather take advantage of the rules that are in place today the best that I can and not worry. I'm not saying don't worry about tomorrow. I shouldn't say that, but we don't know what's going to happen tomorrow. All we know is what we have today. So why not play by today's rules the best way that you
That's
can?
right.
You know?
Yeah.
Yeah.
And there's a lot of great rules out there to take advantage of. I mean, you're referring to, more of a traditional IRA where you pay taxes on the way out. The Roth IRA, you don't ever pay tax. You pay taxes on the way in, but you never pay taxes on the gain. So, there's a number of tricks out there to get your money into a Roth version of the IRA or a 401k. Maybe this isn't the right time to get into it, but there's backdoor Roths for even if you don't qualify on your income. There's ways to do it, and what's legal ways to do it in what's called a backdoor
Yeah.
Roth. It's amazing to me, by the way, how many CPAs I talk with that say, "Oh, you make too much money for a Roth, or you make too much money or you have an IRA that has so much money in it that you can't do a backdoor Roth." If you get to the right CPAs, they know how to do it. You can decide whether it's right for you or not, but there are ways to do it if you want to. So it's extra work for CPAs. They don't make a lot of money on it, and if it's not easy to do, it just doesn't come up. So you really got to educate yourself if you want to maximize your retirement accounts.
Yeah. Yeah. Hey, I know we're going to get short on time, and I've still got a bunch of questions. So I'll just keep going.
Yeah.
I know we'll probably have to, not kidding. Maybe we'll do another podcast is what we'll do, but I want to touch on life insurance. I actually don't use that vehicle. I just have always been more comfortable with real estate, but I noticed that was in one of your subject matters had to do with real estate and relative to life insurance. So what's your take on that? And you'll have proponents from both, but I tend to lean towards real estate myself. So
Yeah, yeah, and I just there's two kinds of life insurance, and I'm not a life insurance guy. I'm not a CPA or an attorney either, by the way. But two major kinds of life insurance, right? One is term life. So term life is when you die, your family gets some amount of money that you set aside, or your policy is set for, and it's relatively inexpensive. It's whatever the payout is that you decide. And if you're in a position where you've got a family that is not already in a place that they can be just fine, and you're worried about it, I think term life is a fantastic security blanket. But it's not a money maker. It's like if you don't die, you don't get anything, and and you just keep paying for it. So term life is, I think, valid for or important for people in certain situations. Whole
mhm.
life, which is, and you hear it called all kinds of different things, but whole life is a combination of term life, but then you're paying a significant amount more to save money that ultimately gets paid out when you die. Or, some of the hooks you hear, and I'm sure you're going to get comments from the whole life people that are out there. You can borrow from yourself, right? And you can go use that money somewhere else. So I've gone through this a few times, and if you dig in under the covers and you try to find out what is the actual return on the money you're putting into whole life, the actual percentage return, it's like under 2%. It's tiny. And so, yeah, you got this nest egg and you can borrow against it and you can get it when you die. But if you look at how much money that is making, it's tiny. I'd rather take that money and
Yeah.
stick it in a money market or something safe that makes very
Yeah.
little. You're going to make more than 2%. And I think there's a lot of
Yeah.
good marketing by certain insurance providers that are leading people that way. And I just think there's a lot of better options. Now, real estate, I think, is a great option, just like you.
Yeah.
But I would say you're better off doing almost anything than whole life.
Yeah. And I agree. And I know I've studied all the life insurance stuff. I actually took classes because I wanted to learn it from the angle of the provider, not just the angle of the consumer. At the end of the day, I just decided, I can do better elsewhere. I mean, it's just because you're, like you said, you're putting money in this vehicle that you can borrow against, but you can only borrow like 80% of it. You can't even borrow all of it to go and do these other investments. If I'd have just done the investments from the beginning, I'd have been better off. That's
Right.
I just again I maybe I'm missing stuff. I know there's tax benefits too, but we also have tax benefits in real estate. Remember, guys, you can build up a really nice portfolio of real estate and you can borrow against it. Loan proceeds aren't taxable, you know, and the interest you pay back, if you do it right way, you could be paying yourself back the interest, So
Yeah.
any case, it's just my take on things. But I'm going to go back to the beginning because we'll make this the last question. Michael, is for people listening, we started the beginning and now we're talking about some more advanced things. But what can we tell the people just wanting to get started? How do you get started in investing in real estate? If you could touch on that, and then we can wrap things up after that.
Yeah, you bet. So I think getting started in real estate, one, you got to educate yourself. You got to be listening to podcasts like this and others. Get smart, read books, and most importantly, find people to work with that know what they're doing. Right? Get closer to people like yourself, Gary, that understand this market and see how you can get involved to help them and work with them and learn from them. That's important. And then, the other thing is it helps to save money, to be honest. Like there's a lot of ways to start in real estate with very little money, with other people's money. But if you have no money and you have no experience and you have no relationships with people with that, you're going to struggle. So get the
Yeah,
relationships with people that know what they're doing. Get money, get educated, and now you got the trifecta to be able to move forward. And then you got to
yeah,
just start. Sometimes it's just hard to start. And it's amazing
yeah.
once you start, things that you sweated over that you thought was like a really big decision and you didn't have it all figured out. You figure it out as you go and it's not that hard. As soon as you figure it out once, you're good.
Yeah. You really touched on some key points there, and I want to re-emphasize these guys and people who know me. And I run a large real estate team. It's not a brokerage, it's a team inside of brokers, but the team is in 38 states. We have trained agents trained to invest so they can walk the walk and talk the talk to work with investors. And our motto is the formula for success is we start number one with the right education, then we get the right information. And the cool thing about the right education, it shows you how to get and use the right information, and then you take the right action and then you get the results. But the action part, I just give you a quick little funny story here. I used to live in Ontario, Canada, and as soon as it got warm, we'd head up to one of the either you got Lake Michigan, Lake Huron, Lake Erie, Lake Ontario, and Lake Superior was too far for us. But in any case, we went up to Lake Huron this one first warm day of summer, and I'm looking at the water. Some people are getting in, tipping their toes, and some people are not. And this kid comes out. He was in full bore. He comes out. He's like 8 years old. I said, "Hey, how cold is that water?" And he said, "Oh, it's not that it's cold. It's just it really hurts." So, the, so the but so the first step, your foot's going to be freezing cold. And by the way, the water that day, the water temp was 46 degrees, and I did the polar bear plunge and dunked under, and I've never felt so good in my life. But the thing is, take the first step. It's not as bad as you think it's going to be, and chances are it's going to be exhilarating. The results you're going to get, guys, from investing, I promise you. Stick with people like Michael Parks. Go to www.nav. It's WF, is that right?
WF.
NAVWF.com.
Yes.
Gotcha.
Navigator Wealth Fund, WF.
Navigator Wealth Fund. Yeah. You know, check it out. See how you maybe fill out a form and have a conversation with Michael or somebody there. Just get started. If you want to come to Monday Night Live class, you can go to the globalinvestoragent.com website, register for Monday Night Live class. It's totally free. We don't sell anything. We don't buy anything. We don't recruit anybody. It's just straight education. Just start there. Work with guys, our service partners like Michael, because they're on here because we trust them. We like what they're doing. They're not on here because I just met him on the street. We interview them. We know who we're talking to. He's a good guy, and he's got a good story. He's still working like a lot of you, and he's investing at the same time. in any case, thank you all very much for listening. Thank you, Michael, for being here. God bless all of you and your families, and we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.